Most people focus on one thing when investing. How much money can I make? But experienced investors ask a different question. What will this cost me? Because investing isn't free. And if you ignore the costs, they can quietly destroy your returns over time. The dangerous part is that many investing costs seem small, a few dollars here, a percentage there, but over years, small costs compound too. Different assets have different types of costs. Some are obvious, some are hidden, some only show up when you try to sell. The key isn't avoiding every cost. The key is understanding them before you invest. Because if you don't understand the costs, you don't really understand the investment. If you buy shares or ETFs, one of the first costs you'll notice is brokerage fees. That's the fee charged to buy or sell the investment. Imagine you invest $100 into an ETF, but the brokerage fee is $15. You immediately start down 15%. 15, and if it costs another $15 to sell later, you're down even more. So before you make any profit, the investment first has to recover those costs. Now compare that to investing $1,000. Instead, that same $15 fee is now only 1.5%. Same fee, very different impact. This is why small investors need to think carefully about how often they invest, how much they invest each time, and what platform they use. Some ETFs and managed funds also charge management fees. This is money charged every year for running the fund. It might look small, 0.2%, 0.5%. 1%, but over decades, those fees compound. A fee charged every year reduces the amount of money compounding for you. That means high fees can quietly reduce long-term wealth. A lot of young people think property investing is simple. Buy a house, collect rent, but property has many costs. Mortgage, interest, insurance, rates, maintenance, and then there are hidden costs, legal fees, vacancies between tenants, unexpected repairs, agent commissions. A property might look profitable until the real costs show up. Experienced investors calculate what's left after expenses, not just how much rent comes in. Physical gold and silver also have costs. One of the biggest is called the premium. That's the extra amount you pay above the metal's market price. There can also be shipping costs, storage costs, and insurance costs. Crypto also has investing costs, trading fees, network fees, withdrawal fees, conversion fees. And because crypto prices can already be volatile, high fees can make it even harder to make money consistently. Even businesses have investing costs. Equipment, marketing, software, staff. Sometimes people focus only on revenue without understanding expenses. But revenue is not profit. Don't just ask, how much can I make? Also ask, what will this cost me? Costs influence how often you invest, which assets you choose, and how long you hold them. Investing plans should be realistic, not emotional, not rushed, and not copied from someone else online. The goal isn't to avoid every cost. The goal is to make sure the potential reward justifies the cost and the risk. Smart investors don't only study returns, they study costs, risk, cash flow, and long-term sustainability. That's how you build assets properly over time. Disclaimer: this content is for general educational purposes only and is not financial advice. Investing involves risk, and you should always do your own research. Subscribe if you want to learn how real assets create income and options over time.